Next question. A company has sales of 75 lakhs, variable cost of 42 lakhs, and fixed cost of rupees 6 lakhs. It has a debt financing of rupees 45 lakhs at the rate of 9% interest and equity of 55 lakhs. The first question is, what is the firm's return on investment? That is a question. And then the second part of the question is there. I want you to compute answer of the first question and please put your answer in the chat box. Dear students, for the purpose of calculation of the return on investment, basically there are two things that we have. Either it can be on the pre-tax basis or it can be on post-tax basis. Dear students, in this question, income tax rate is not given. So there is no point of making the calculation on post-tax. We have to compute answer on pre-tax. So I request all of you to write down answer along with me. Working note number 1. Calculation of earning before interest and taxes. So the question is providing the information about the sales. Amount of the sales is 75 lakhs. Less variable cost. Amount of the variable cost is 42 lakhs. So this is the point at which we generally compute contribution. The amount of the contribution is 33 lakhs. And from that we deduct fixed cost. Amount of the fixed cost is provided to us, an amount of 6 lakhs. So that will give us earning before interest and taxes. 33 minus 6, that comes to 27 lakhs. This is the way we compute the operating income. Next, calculation of return on investment. I am writing in the bracket, it is pre-tax. It is earning before interest and taxes divided by capital employed. Earning before interest and taxes is 27 lakhs. Divided by the capital employed is consisting of equity share capital plus debentures, because no other information is given to us. So it is 27 lakhs. Equity share capital is 55 lakhs. Plus debentures is 45 lakhs. So 27 upon 100. Into 100 lakhs, I'm sorry, into 100 for getting answer in percentage term. So it comes to 27%. I request all of you to write down answer 27%. Second part of the question. Does it have favorable financial leverage? I request you to give answer for the second part of the question in the chat box. Now friends, we can give answer for the second part of the question by like one of the two methods. I request all of you to pay attention. Second part of the question. Please write down answer along with me. Working note number 1. Working note number 1. calculation of a return on equity. In that, we can say it is earning before interest and taxes an amount of 27 lakhs, less interest. There is a debt financing of 45 lakhs and the rate of interest is 9%. So it would be 4 lakh 5,000, I think. So earning before taxes, that comes to 22 lakh 95,000. Earning after taxes is again 22 lakh 95,000. Why? Because tax rate is not given. There is no preference dividend. As far as the equity share capital is concerned, it is provided as 55 lakhs. So in that case, we understand it is like the earning available to equity shareholders 22 lakh 95,000 divided by 55 lakhs into 100. So the return on equity is 41.73%. Return on equity is 41.73%. So what you can do, say you can draw a conclusion like this, that say the we are able to earn only at the rate of 27% from the business, yet equity shareholders are able to earn at 41.73%. So the company means equity shareholders have favorable financial leverage in a way that say we understand that so the introduction of the outsiders financing has say an edge, say it gives a like an advantage to the equity shareholders. That is what say we can draw a conclusion. So the conclusion is return on equity is 41.73 percentage, comma, it exceeds return on capital employed 27 percentage. So there is an advantage of raising debt finance, full stop. The company has favorable financial leverage. Full stop. This is what we understand. At the same time, a smart student like you can also have a working like this. Means for only for understanding, 100 lakhs is divided into two parts. 55 lakhs is the own financing. So equity is 55 and debt is 45. On our own investment, we earn at the rate of 27 percentage. So 55 lakhs into 27 percentage. So the answer is it is 55 lakhs into 27 percentage. 14 lakh 85,000. For the debt financing 45 lakhs, we earn at the rate of again 27 percentage, but the cost of debt financing is only 9. Okay, so we earn excess by 18 percentage. So 45 lakhs into 18 percentage, that comes to 8 lakh 10,000. So basically, so this 8 lakh 10,000 is so the additional earning that the equity shareholders have. So basically, the equity shareholders' total earning increases to 14 lakh 85,000 plus 8 lakh 10,000, 22 lakh 95,000. 14.85 plus 8.10 divided by 55 lakhs into 100. You'll get the answer as 41.73. This is the way you can also cross verify the answer. This is the first very much detailed method. Instead of this detailed method, what you can do, you can give answer like this also. Listen carefully. Return on capital employed is 27 percentage. Rate of interest, because both of them are pre-tax, is 9 percentage. 27 exceeds 9, yes. So the equity shareholders have favorable financial leverage. That is what we understand. Return on capital employed exceeds the rate of interest. So the equity shareholders have favorable financial leverage. That is the way we can draw the conclusion. A small revision of the answer. In the first part of the question, we are required to find the return on investment. Of course, it is pre-tax. Why? Because the tax rate is not given. The second part of the question is very important. The question says that whether raising the debt financing is working favorably for the company, means for the equity shareholders. Answer is yes. Why? Because the return on equity is 41.73%. It exceeds the return on capital employed 27%. That is the reason. Or otherwise we can say that the return on capital employed is 27 while the rate of interest is only 9. That is the reason raising the debt financing is working favorably for the company.